Shopify is up 58% over the past year. They are reporting earnings this Tuesday, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, Shopify has grown revenue from $1 billion in 2018 to 6.6 currently. In this regard, analysts are expecting them to reach almost 15 billion in 2027. Moreover, the e-commerce sector is expected to grow at a 15% compounded annual growth rate. Shopify allows anyone to have an online store where they can sell physical goods. They make money via subscription services, which makes around 486 million per quarter, and merchant services, which makes 1.2 billion per quarter. Regarding profit, this company is unprofitable in terms of net income, but they have started to show free cash flow. In this regard, analysts are expecting them to make $2.54 in 2027. If you assign a 30p to the company then, it would make it a $75 stock, meaning a negative 7.4% total return. Then, in order to calculate the intrinsic value of the company, I used my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These three numbers are the intrinsic value according to net income, and these three according to free cash flow. These numbers mean that in order to make the desired annual return that I have put in, which is 13%, you need to pay these prices. I went with 13% because you can get around 10% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. The stock is currently trading at $81 a share. Therefore, if the low assumptions occur, you're going to make a negative 10% annual return on your money. Middle, 2.5%, and high, 12%. For my revenue assumptions, I did 18% annual for my low, 22% on the middle, and 26% on the high, which is around what analysts are expecting. I assumed a profit margin and free cash flow margin of 10% on the low, 17% on the middle, and 22% on the high. They currently have a negative profit margin, but free cash flow is already 10%, and I think they can achieve these assumptions because their gross margin has been around 50% for the past 2 years. I assigned a PE and price to free cash flow of 20, 23, and 26, and I left the share outstanding change at 0%. However, they have been issuing a lot of shares over the past years, and if we consider that they issue 2% of their shares annually for the next 7 years, the valuation becomes even less attractive. The stock looked very attractive when it was trading around $25. Moreover, because it's an unprofitable company, we can use the price-to-sales ratio. Shopify is trading at a price-to-sales of 15, which is quite expensive. For comparison, Google is trading at a price-to-sales of 5. Regarding the balance sheet, this company has an amazing balance sheet with $5.7 billion in cash and only 1 in debt, which is nothing for a company with a market cap of 100 billion. In conclusion, I believe Shopify is a fantastic company with a great balance sheet and a lot of growth potential. However, the valuation looks very expensive and the increase in the number of shares outstanding is concerning. I hope you found this video valuable. Let me know what you think about Shopify in the comments, and I'll see you in the next one.